This is Andy Kim. Welcome back to Intermediate Corporate Finance, right? Today we're going to talk about equity risk premium, which is a very important component of the cost of equity. And this cost of equity is, of course, the discount rate that we're going to use in DCF valuation, especially when you're using equity cash flow method, free cash flow to equity method. Okay, let's see, right? One after another we are going through, and then last week we talked about the risk-free rate in the discount rate model, as you see over here, right? Discount rate, required return, that is our destination. But for that part, we had to start from the risk-free rate, okay? Risk-free rate. And the idea is this is the opportunity cost of capital, right? So from the perspective of the investors in the capital market, I have $1 million to invest, okay? I don't want to waste this one, okay? So if I'm going to put my money into your project or your company over the next 1 year, right? First alternative I can think about is a risk-free investment. Put my money into the Treasury market, US Treasury or Korean Treasury or whatever risk-free market, okay? So as long as your investment opportunity, okay, is riskier than, this risk-free asset, of course, is risky, right? Then I want to get compensated somewhat more than what I could expect from risk-free investment. So I want some risk premium, okay? Last week, we spent a lot of time about how to get to the true risk-free rate. Remember, when there is a risk-free entity in your country, AAA country, versus non-AAA countries, right? We need to single out that default spread, okay? Or default premium, okay? Because that's the component that is not compensated with risk-free asset, truly, okay? So you want to get to the true risk-free return. Then what do you want to do? Well, we want to add the risk premium. Again, this is opportunity cost of capital concept, right? So as long as your investment opportunity is risky, I want to get compensated, okay? I want some expected return, okay, from your investment opportunity as much as the risk premium. How to model that risk premium? Well, that's something we're going to talk about from now on, okay? That takes us to the second line over here in that equations, right? So the green item is the same, true risk-free rate is the same, plus beta times market risk premium. That's our destination using something called the capital asset pricing model, okay? Here we are trying to analyze the risk premium of any security, your company, let's say, okay? Your company's risk premium. Let's analyze it, okay? Decompose it somehow, okay? If you try to understand it, here's the framework, capital asset pricing model. It says there's one important macro factor that affects this risk premium. And this risk premium, by the way, should be a function of your risk aversion. More risk averse, more premium, please give me. Okay, that kind of concept. Now this risk premium, how can we decompose it? In capital asset pricing model, it's going to be market risk premium times beta, market beta, right? If you want to go for more advanced finance, then you will realize that capital asset pricing model is just one special model, whereas the more general model could be there, is there, right? More general model, what do you mean? Well, instead of just having one risk factor, okay, there could be multiple risk factors that are independent of each other, okay? And try to decompose and understand all this risk premium in more scientific ways, okay? But this class, we are not going to talk about that multiple factor model kind of things, but we're going to focus on capital asset pricing model, one factor that you have to focus on. So the first is that we have to talk about the market risk premium, which applies to the whole securities, whole risky assets commonly. Okay, this is something we call price of risk. Okay, in more advanced terminology, the price of risk. The price. Why call it? Why do we call it the price? Okay, it gets back to the idea of any single company, any single investors. We are all price takers. Okay, that price, okay, the price of risk is determined in the market. Okay, in equilibrium. Okay, the price of risk is determined in the market, and then we are just simply taking that price. And for different companies with different risk characteristics, okay, those companies carry different quantity of risk. Okay, quantity of risk. Price versus quantity. What does that mean? I mean, does it sound familiar to you? I mean, if you remember your discussions in Economics 101, okay, microeconomics, basics, right, in the market. You're a price taker, and then price times quantity makes revenues kind of things, right? Price times quantity. And we are trying to interpret this market risk premium in that kind of concept, right? The price of risk times quantity of risk, that should give me the total risk premium. Make sense? So that price of risk is something determined in the market and is commonly shared all across different investment assets. Each different security, each different company, they just carry different quantity of risk called beta. Okay, so our ultimate measure of risk will be beta. Okay, so if you understand all this discussion, you're good to go. Say bye-bye. Okay, you don't need to listen to the rest of the lectures, but that's basically what we're going to talk about. Okay, risk and return trade-off. Right. We should understand it a little better. Okay, or I will bring you some refreshers. Right, I should say. Now, risk in traditional terms is viewed as something negative. Okay, risky means something dangerous you want to avoid. Okay, Webster's dictionary, for instance, defines risk as exposing to danger or hazard. Okay, the Chinese symbol for risk, reproduced below, give a much better description of risk. Risk equals 위기 in Korean term pronunciation, and 위험 plus 기회 is, the, how do you say, source of these two characters, I would say. If you look at those two characters of 위기, right? Risk. Well, in Chinese pronunciation, is like 危机, right? 危机, is that right? Any Chinese audience over here, right? 危机. So two Chinese characters, you can decompose it, and it becomes 危险. 危险 means like a 위험, some danger, right? Danger. And then plus 机会, that's 기회, that's opportunity. So, what's the interpretation? Well, risk, okay, 위기 is a opportunity in disguise of danger, or danger in disguise of opportunity. We don't know which side of the story makes more sense, but as long as Warren Buffett kind of guy is saying is that this is an opportunity in disguise of danger. Well, if you look at today's market situation, stock market, right? By the way, today is March 25th or something, and the stock market went up like 5.5% or something on average, right? And then yesterday, the Korea's Kospi stock market, okay, index went up by like 10% or something. Crazy up, okay? Interesting thing is, some of my former students, right, especially the one I taught in Singapore, like Jonathan Lin, right? Asked me, right, over the Facebook and said, hey, professor, okay, like 10 days ago, that day the market was tanking like crazy. The index level was plunging down like 6% or 10% per day, and all these sidecars and then those circuit breakers were turned on so that you cannot trade, right? In that kind of dangerous situation, my student, right, Singaporean student, asked me Facebook, hey, Andy, Professor Andy, isn't this the very situation that you talked about as an opportunity in disguise of danger? Okay, so I said, hell, did I say that, man? Yeah, perhaps you're right. I'm more of a theorist, right? I'm telling you in teaching in theory, but you're practicing it, right? But I want you to be careful as well. It is so scary, right? Just be careful. I cannot take responsibility for you. But he is the CFO of M Clinica, a medical big data company in Southeast Asia. I mean, I guess this is a very busy time for him to work, and a lot of medical issues going on all around the world. But his company was highlighted by Forbes, and then very famous guy over there. Anyway, so likewise, the guys in the industry, they have this kind of sense, right? And guess what happened over the last couple of days? As you saw, right? Drastic changes happen, and then if the guy purchased the stock at that moment, maybe I guess he must have earned like a 10% or 15% by now, in a couple of days. So the risk, okay, opportunity in disguise of danger, right? Or vice versa. You have to be careful. So this is important thing is the risk is not just a negative story. Okay? It's about positive and negative side at the same time. This is very important distinction that you have to make. Okay? This really separates the finance guy versus non-finance guy. Okay? Risk always is like a double-edged sword, up and down. How can I show you? Up and down, right? Up and down. This is about risk. Okay, less risk versus more risk. Okay, you can see me as my eyes, right? Less risk or risk-free. Okay, versus more risk, risky. Okay. So today's market, is it risky situation? Of course, you see a lot of more ups and downs, a lot more uncertainty going on. So we have to be careful, okay? So that's one thing I have to tell you. The notion of benchmark. Since financial resources are finite, there is a hurdle that projects have to cross before being deemed acceptable. This hurdle should be higher for riskier projects than for safer projects. Makes sense, right? The hurdle, okay, if it's going to be very dangerous and uncertain projects, I'll be more spooked, okay, to spend any of my money, any of my dollars, right? So the risk premium that I want to charge, okay, that I want to require from this investment should be higher. High risk, high required rate of return. Low risk, low required rate of return. Okay, that's the idea. A simple representation of the hurdle rate is as shown below. Required return equals riskless rate plus risk premium that I showed you before in 2 slides ago. The 2 basic questions that every risk and return model in finance tries to answer are twofold. How do you measure risk? And how do you translate this risk measure into a risk premium? Okay, are they in the same format or unit so that we can interchangeably use it, or do you have to transform it somehow? Okay, is the issue. Okay, how do you quantify the risk? Those 2 things. Now, good risk and return. Wait a minute. Model should do the following things, right? One, it should come up with a measure of risk that applies to all assets, not one specific class of assets. For example, stocks, bonds, they are two different classes of assets. And then real estate, yeah, 강남 부동산 kind of baby, right? Actually, most of your parents will think about the real estate only in Korea. Okay, stocks and bonds, they rarely think about it, but 부동산 or real estate, we call it alternative investment. And how about gold and silver, precious metals, and then commodities like oil, natural gas, as well as crude oil. Did you see the crude oil price today? Okay, I'm gonna go ahead and check it. I'm gonna ask you in the homework question or some assignments, okay, to keep up with this information yourself. Okay, crude oil price and all these kind of things, right? Can we apply this risk and return model to this kind of all different assets? It should be, okay? We should be able to. It should clearly describe what types of risk are rewarded and what types are not rewarded, okay? Here is the important part. One thing, okay? There are a lot of, whole bunch of different kinds of uncertainties there. High risk, high return. Is that always going to happen? Okay. Some kind of risk are not compensated, which means tough luck to you. Okay. No way. Some kind of risk is expected to be rewarded. Okay. That's how this model predicts. Okay. Model works. Okay. For the kind of risk that is not rewarded, we are just blindfolded for that part. Okay, it's your own at your own risk. You take it. If you get compensated, good luck. But on average, those parts, there are some parts. We're going to talk about it later. Are not going to be rewarded by the model, right? It should come up with standardized risk measure, right? I.e., an investor presented with a risk measure for an individual asset should be able to draw a conclusion about whether the asset is above average risk or below average risk, okay? And then we need some standardized measure, okay? One kind of risk and the other kind of risk, right? Or one company's if it applies in certain way for certain kind of assets and doesn't work for some other kinds of assets, you're in trouble. So we need some standardized risk measure. And number 4, it should translate risk measure into a rate of return. You'll see that the unit of risk is not in the unit of return. Okay, percentage return. Okay. We want to translate those risks into this kind of percentage return somehow. What's the translator? You're going to learn about it. And the investor should demand as a compensation for bearing the risk. And number 5, it should work well, not only at explaining past returns, but also predicting in the future expected returns. Okay? So this is commonly, the number 5 is a common problem when you're dealing with the big data or historical data, okay? It should be explaining the past pattern very well, but it also has to be, how do you say? It also has to have some strong predictive power or forecasting ability, okay? How can a model have that kind of powers in both ways? Okay, explaining past and then predicting the future. Out of sample testing. How can we make this kind of model? Well, the answer is it should be based on a solid theory. A solid theory based on some existing existing disciplines, strong disciplines. For example, it should be based on economics, okay, economic theory, right? You cannot randomly find out any pattern out of your data and then say that kind of things will happen in the future as well at random, okay? You could be just picking up some spurious correlation. You must have heard of it many times by now. Spurious correlation versus some correlation that can be explained by solid economic theory, okay? So you want to get it explained by solid economic theory. Otherwise, drop it, dump it, okay? So that's important part. Okay, of course, economics is is not the only discipline that exists in the world, right? Sometimes you may be able to resort to other disciplines like psychology or sociology, all these kind of things. But so far in finance, most of the things have been based on this economic theory, okay? And it makes sense, right? At least it makes sense. So let's go. Now, capital asset pricing model, okay? This, it uses variance of actual returns around an expected return as a measure of risk, okay? Variance. It's kind of mean variance world, okay? Mean variance, okay? That's the terminology you want to use. This is the word of mean variance. The expected return should be the mean, and then the variance is the risk, okay, of this asset. It specifies a portion of variance, okay, that can be diversified away. That is only the only the non-diversifiable portion that is rewarded, okay. Which part of risk is rewarded versus which part is non-rewarded, okay. Something that is diversified away, something that is non-diversified away. Well, if it is non-diversifiable, then it should be rewarded somehow in the market. If it is diversified away, not necessarily it should be rewarded by the market, because you can always diversify it and then forget about that idiosyncratic part of the risk. So that's the idea. Number 3, it measures the non-diversifiable risk with something called beta, which is standardized, okay, around 1. Okay, standardized measure around 1. Beta, right? So that's the thing. Number 4, it translates beta into expected return in a nice format like this. Expected return should be equal to risk-free rate plus beta times risk premium, okay, risk premium. Number 5, it works as well as the next best alternative in most cases. So more sophisticated models keeps on coming up, but still, this simple model takes you a long way, okay? So that's the benefit of the strong point of the capital asset pricing model. Now, the mean variance framework, okay? Here's the concept of total risk. Well, you look at, first of all, to think about this risk, you should be able to compute the return first, right? I found some cases that students try to compute the return based on, risk based on the price itself, okay? Well, total risk, the concept of it is the variance of return, okay? Variance of return, not the variance of the price, okay? You have to be careful about it, okay? The variance on any investment measures the disparity between actual and expected return. So in the diagram, in a very simplified diagram that I show you below, over here, right? What do you see? Well, on the horizontal axis, you see expected return, okay? And let's say there is a histogram of return. I'm going to show you later, okay? With actual histogram of returns, daily returns, I'm going to show you. Let's say you plot a histogram of daily return or monthly return over many, many years, right? Okay, for two kinds of assets. Okay, one red colored one is a high risk asset. Blue one is like a safer asset. Okay, what's going to happen over there in the histogram? Well, in the histogram, you are going to see that those histogram bars would be widely dispersed for high-risk securities and tightly distributed for low-risk investments. Okay, and total risk is represented as a standard deviation of these returns. Okay, so a total risk of a stock, right, for red stock. So that's going to be the standard deviation, let's say, over here. Standard deviation, for example, over here. Familiar? Right. This guy will be the measure of total risk. Now, how about the, how do you say, blue, right, asset, right? The standard deviation of the blue asset will be much smaller, as you see, tightness, right? So risky versus low risk companies, right? This is our typical measure of total risk, but this is not the end of the story. This is only the beginning. Now, okay. Wait, pop-ups just bothers me. Anyway, let's see the risk and return of the following three cases, right? I'm going to bring two stocks. One is Celltrion, a biotech company. Okay, Celltrion, 서정진 회장님. You see it, right? Nowadays, it's making a lot of news because the CEO announces that they're going to make some cure medicines for this Corona-19 virus, right? Or testing kits or whatever, right? He's trying to sell what's going on in his R&D, right? Very combative CEO, by the way, very masculine ones, okay? Whenever there is a short sellers, right? Short selling his stock, his company's stock, he's gonna be pissed off and then go to the media and say, no, you should not short sell my stock, kind of things, okay? LG Chemical is the next one we're gonna compare, okay? That's petrochemical company, basically. Petrochemical, what is that? That is your plastics and all these kind of products that you see in everyday lives, right? Also, they make what's that? The rechargeable batteries, right? So two stocks we're going to compare using the histogram of daily returns. Also, as a third step, we're going to create a 50-50 portfolio of Celltrion and LG Chemical so that we're going to see how the risk changes, okay, if we form a portfolio. Okay, the first two cases, it's going to be like as if we are investing 100% of our money into Celltrion only, or 100% of our money into LG Chemical. Okay, the third case is like 50-50 split. Okay, our concern will be about this portfolio's total risk. Okay, why? Because you must have started your virtual investment by now, right? You have 1억 won or 100 million Korean won in your virtual account, right? So what do you care most? Well, the riskiness of your portfolio, your money that you got, right? Each and every single company is in your portfolio. You care less. Okay, don't care as much. Okay, because you'll see later on. Okay, you see why. Okay, so here's Celltrion. Their daily stock returns are shown over here in a time series plot. Okay, time series plot. Let's see. Of course, you all understand this return concept, so that I don't need to tell you about it. So, considering dividends, I created the daily return chart like this, up and down and up and down. Remember, this is daily basis, okay? One day, some days, you earn 15%, okay? In a single day. Jesus. Don't stop there, right? You wish you earn 15% return every day over 1 year. Well, you're gonna make a huge amount of money, but that doesn't happen. Okay, the next day it plunges by 15%. Crazy. Okay, winning 15%, losing 15%, you're going nowhere, right? And sometimes it goes even further, like a 20% up and down, right? Sometimes, of course, there are some tranquil period or peaceful period. Okay, the daily return is only like 1% up or down. Okay, this is Celltrion, biomedical company with short history. Here's a contrast. LG Chemical, right? LG Chemical, typically their return, daily return, is in the range of plus and minus 2% or less, right? Of course, there are some days they lost 15%. Oh my God. Okay. Or their price, they had about 10% plus return on some days, right? But usually their return is less volatile. And the next one, here I plot those two charts in two pictures in one chart, right? Celltrion and LG Chem, showing you in one diagram like this. So you can immediately see, okay, that Celltrion is riskier than LG Chemical, right? Yes, stock return volatility is so huge, okay, so huge, much bigger than the stock return volatility of LG Chem. But that's not the whole story yet. Here's a histogram of Celltrion's returns, right? Daily return histogram. And then you see average and standard deviation like this. Standard deviation of return 3.16%. So which means if Celltrion stock price goes up by 3.16% or less, no surprise. Okay, it's supposed to be going up and down. How about LG Chemical, right? Average 0%. What? The LG Chemical stock price was not going up, okay, over this sample period until 2017. And then standard deviation of return is 2 percentage points, okay, which means 3 percentage points up or down in the stock return is a big surprise for LG Chemical, right? Whereas it is not a surprise for Celltrion, okay, good. Now, if we move on, okay, which company is riskier? Of course, Celltrion. Which company has bigger expected return? Okay, come back again. Expected return or average return, right? Historical data says that average return is bigger for Celltrion than LG Chemical. Okay, if we hold on to this, right, and then we believe that the future will be the same as the past, then the expected return will be bigger for Celltrion than LG Chemical, of course, right? Question 3. If you create a portfolio of 2 stocks where 50% of your money is in Celltrion and the remaining in LG Chem, what would be its expected return and risk like? Is the next question, right? It is much more realistic because you as an investor don't put all your eggs in one basket, okay? Oh, I'm risk averse, so I'm going to put all my money into LG Chem. Don't do that, man, right? What if LG Chem goes bankrupt, okay? These are all my money into Celltrion. Don't put all your eggs in one basket, okay? Diversify and hedge, okay? Always hedging your bet. That's what finance guys are about, right? 몰빵 금지 in Korean terminology. No 몰빵. 몰빵 is like putting your all eggs in one basket, okay? Now, histogram of a portfolio 50% looks like this, okay? Let's see the mean and then standard deviation of these returns. Mean is 0.11%, which is the middle of LG Chem and Celltrion, of course. Standard deviation is here. Interesting, very interesting. 1.95%. 1.955%. Compared to the case of 100% invested in LG Chem, right? The standard deviation got reduced, right? Mixing with the risky stocks makes it less risky than the less risky than even the less riskier stock. Okay, put it this way again. Making a portfolio between LG Chem, that safe stock, and Celltrion, right? Supposedly risky stock. The portfolio becomes safer than LG Chem. That's a surprise, right? Very interesting one. The standard deviation got reduced, yet the average return increased. Okay, how can that happen? Okay, why? Because of the correlation. Okay, not the correlation of prices, but the correlation of the returns. Right? We have to be careful a little bit. Now let's see. This discussion about marginal investors need to be set up first to clarify your thoughts, okay? Risk is related to the return, and the realized return is computed as follows, which is price of today minus price of initial purchase, right? Divided by the initial purchase price. Or price of today minus initial purchase price plus dividend today divided by the initial purchase price, okay? In case there's a dividend, by the way. Now, return is based on the price in the market, right? And so, to understand the required return better, we need to take the perspective of the investors that sets the price of the assets, okay? Who sets the price of an asset? Because it's an important question. Who sets the price? Usually, in a perfect competition market, individuals like you and me, we are just price takers. Whatever they set the price, right? Whatever price they set, we're just taking it as a passive guys, right? But we're talking about the price setters who are setting those prices, okay? And we're going to take their perspective, okay? Why? Because the returns, all those things are based on the price set by those investors. And those investors, we call them marginal investors. 한계 투자자 in Korean terminology. Okay? In your Finance 101, you must have learned that, we have to take the perspective of marginal investors for some reason we don't know, but just let's memorize it, okay? But here I'm tackling the issue of why, okay? Why I need to take the perspective of the marginal investors. Not like you and me, Cammy, right? Or ants, like individual investors, but marginal investors. Why do we care about their eyes, right? Well, why is diversified portfolio manager a marginal investor most of the time is a question. Usually we say marginal investors are those, well-diversified portfolio managers, right? For example, national pension funds or Samsung Asset Management or BlackRock Asset Management. Those asset managers, right? Mutual fund managers, Vanguard kind of guys. Why are they, okay? Marginal investors who sets the price, but not me, Andy Kim. I want to be a marginal investor, please. Wasn't I? Okay. Yeah, you could be in some rare cases, but most of the time, the marginal investors would be those well-diversified portfolio managers. Which one would be the marginal investor, okay? So here's my question. Consider a bidding war between Andy Kim, me, right, and Korea Investment Corporation, which is 한국투자공사, right, to purchase a share of Hyundai Motors, HMC, right? I'm gonna say it HMC. Each would bid up as high as his or her valuation number about this company, HMC, right? Hyundai Motor Company. So, the thing is, let's assume that me, Andy Kim, and KIC have the same information, okay? You may wonder, like, some guys who know about finance a little bit, like, will always say, wait a minute, Andy Kim is a small guy versus KIC is a big guy, so they have more better information and that they are more flexible, blah, blah, blah. But forget about it, okay? Let's abstract away from that. Let's assume that Andy Kim and then KIC, they have the same information, okay? I have Bloomberg maybe, and they have Bloomberg Terminal as well, and then we have the same, okay, same analysts talking to me and them, right? So the cash flow information will be the same, okay? This is Hyundai Motor commonly, right? And then the growth rate expectation of this cash flow will be the same, okay? For example, right, the valuation formula would be the same. So what you see on the left-hand side versus right-hand side is that left-hand side and his valuation estimate, okay, of Hyundai Motors. And right-hand side is the valuation estimate of Hyundai Motors by KIC, right? KIC. Now, all based on the same information about the cash flow and its growth rate. The only difference, okay, is the discount rate that we use. Andy versus KIC. Discounting the Hyundai Motors future cash flow. Okay? Which one would be bigger? Okay? Based on this, which value estimate, whose value estimate would be bigger? Okay? Based on this, me, Andy Kim, my bidding on Hyundai Motors, right, share will be based on my discount rate, okay? That discount rate will be a function of the perceived risk of Hyundai Motors, okay, upon my wealth. And then I am 100% invested in, I will be 100% invested in Hyundai Motors, right? Because I'm individual investors. And I don't have much money, okay, honestly. And then in contrast, KIC may have a different exposure. For example, Hyundai Motor could be just one of many hundreds and thousands of different companies that I own, okay, kind of things, right? So, based on that, the risk they perceive about Hyundai Motor, okay, would it be the same as the risk of Hyundai Motor that I perceive as Andy, right? Is an important question. Which would be bigger, assuming cash flow and G are identical between Andy and KIC? It boils down to the question of which is bigger, the discount rate on Hyundai Motors by Andy or discount rate of Hyundai Motors by KIC. Which one would be bigger? Okay? To which one Hyundai Motor would be more scary? Okay? Would it be scary to me or KIC, right? That is an important question. Now, to answer this question right away, okay, it would be like this, right? It would be like this. To me, this is the only asset that I have. If Hyundai Motor screws up, my whole wealth is going to be screwed up, okay? So my discount rate or risk premium that I want to charge on that guy will be bigger, okay, compared to the discount rate by KIC, right? For KIC, Hyundai Motor is just one of the many guys. If they screw it up, man. The other component stock will compensate, and they just make, my portfolio balance each other out somehow, okay? Or the damage will be minimal at least, okay? So this will be what happening. What's the consequence in this diagram over here? Okay, what's the consequence? Well, the denominator, okay, is bigger for me, smaller for them. Okay, I see. So which one can come up with higher valuation estimate for Hyundai Motor, the same company? Of course, this guy will come up with bigger valuation estimate, right? Because of the inverse relation between the value and discount rate. So if I and Kim go into bidding war with KIC, okay, if both of us are rational and doing this kind of DCF, right? Would I ever be able to beat them and then buy Hyundai Motor stock in competition with KIC? No, okay? No, okay? So KIC will be the setting the price, okay? And they will be giving the best, value estimate based price that they charge, right? So that's the basic idea. So that they will be the price setter. Now let's see. Diversification and the portfolio risk is shown over here. So here we are trying to understand KIC's perspective a bit more, okay, a bit more. So what you see on the vertical axis is the total risk of portfolio and okay, in annualized risk, okay, total risk. Here it's standard deviation of portfolio return, okay, on a yearly basis, right? That's why we have 35% or something, okay? And what you see on the horizontal axis is the number of stocks that you have in each portfolio, okay? So the first portfolio over here, let's see, this guy, okay? This one is one stock portfolio, 몰빵 case, right? If you invest 100% of your money into one single stock, okay, then you're going to have this kind of high total risk, okay, in your portfolio. Is it always going to be 35% if I invest in one only stock? No, okay, no. This is just an example, okay, one stock that I don't remember which stock it was, right? But it was 35%. If you chose a wrong stock, okay, could have been 50% or 90%, we don't know. But typically, it will be very, very high. The key idea is not that magnitude itself, but the important part is the decrease in total risk of the fund, total risk of the portfolio, as I increase the number of stocks held in this portfolio. So 2 stocks, 3 stocks, 4 stocks, 5 stocks, as I increase and diversify my portfolio instead of concentrating it on one stock, right? What I see is that the total risk of the portfolio goes down in exponential manner, okay? But it doesn't go to zero. That's another interesting part of it, okay? First part, well, the total risk goes down, okay? Why? Because of correlation, which is not a perfect correlation, okay? When a good news for one stock could be a bad news for another stock, okay? So they may cancel each other out to some degree. So that's why. But the next thing important is that the total risk of this portfolio never goes to zero, and it stays at some level. Okay, stays at some level. And so the risk over here, okay, diversifiable or idiosyncratic or unsystematic or firm-specific risk is there for you, which is going to be diversified away as you form a well-diversified portfolio, okay, into many, many different stocks. The risk of this total risk of the portfolio that does not go away even though you have 30 different stocks or 100 different stocks, right? This is called a systematic or market risk or undiversifiable risk. Okay, there is a fluctuation going on. There is an uncertainty going on in the macro level all over the market, and that you just cannot diversify away. You just have to suffer. You just have to take it. Okay, and if a stock affects this, right? The question becomes like this: if one stock, Hyundai Motor or something, affects this systematic risk a little bit, okay, for some reason, then the marginal investors may care more. Andy does not hold diversified portfolio. In fact, Hyundai Motors would be his only asset. So, whenever Hyundai Motors CEO does some crazy things, I will be really, really afraid. Okay, don't do crazy things, please. I have to hope and pray so hard. I will be so much afraid. I'm exposed to total risk of Hyundai Motors. Okay. KIC, on the other hand, is a perfectly diversified portfolio manager. So KIC manager would not be afraid of the idiosyncratic risk of Hyundai Motors. If Jung Il-sung screws up the company for whatever scandalous misbehavior he does, I hope he doesn't, but if he does, well, I don't care because I have what? Volkswagen in my portfolio, he would say, okay? Or maybe GM, right? Some of my friends said that they purchased Volkswagen because Hyundai Motors car is too expensive, and then the Volkswagen is cheaper, okay? Competitors, bad news is good news for me, right? Usually it works that way. That's idiosyncratic risk that can affect differently. Yeah, his concern, like KIC managers, is this: how much does the HMC stock make my total portfolio more risky or less risky? How much is this? The total portfolio, by the way, okay, total market portfolio, is affected by macro level news, macro level shock, coronavirus 19. Oh my God, okay? To this macro shock, some stocks are more sensitively going down or up. Some stocks are less sensitively going down. If it is more sensitively going down, then it will crash down upon my portfolio much more. Okay? So that kind of market risk is an important thing for KIC managers. For example, macro level demand shock, right? Global level demand for car driving, okay? How many people will be driving more or less? Can you drive anything these days as much as before? Okay? We don't need cars these days. You need Netflix. You need YouTube, because you have to spend some time watching those things, and you have to spend some time watching my lectures. Yes. Instead of driving for clubs or anything, right? So intuitively, the discount rate that I charge as Andy for Hyundai Motors will be bigger than the discount rate a KIC charges. So consequently, valuation number will be the other way around. So rationally, I will be always bidding lower price than the bidding price of the KIC. So I will lose, they will win, they will set the price in the market. I'll be just price taker. Oh, you set the price as such. I follow you, even though it is not really, making me happy. Okay. Anyway, so why should we care about marginal investors being diversified? Marginal investors equal diversified investors most of the time for publicly traded companies. This is not so for private companies. Okay, if it is not listed in the stock market, those marginal investors, those setting the price, will be less than fully diversified. For example, I could be my marginal investor of my own single company. Okay, nobody holds the stock, then I would be. Venture companies, right? Startup companies. The founder will be the marginal investor. Okay, we didn't even sell the stock, right? Sometimes, if you have got some venture capitalists got in there, the venture capital that venture fund could be a marginal investor because, the guy would be setting the price with more diversified portfolio than the founders. Make sense? Right? And then the thing is, venture capital, they are less than fully diversified if we compare. Right? Venture funds, they typically hold 10 to 20 different stocks. Okay? Whereas the asset managers that I talked about before, they carry like tens of hundreds of or thousands of stocks over there. Now, when valuing private company, your method of estimating required return would be different. So expect that difference in the future, but for the sake of the simple class discussion, CAPM or the marginal investor being that well-diversified portfolio managers, this is good enough, right? Now, if time permits, we're going to go through the private company valuation, right? So that kind of complication may happen in the future. Then, what diversified portfolio manager would think about HMC in picture, okay? Diagram-wise, it would look like this. If adding Hyundai Motor Company to my market portfolio, the KIC managers, and then adding this HMC makes my market portfolio more risky, I will not invest in HMC unless it gives me higher return, okay? I will demand higher return, okay, required return, okay, somehow. Notice it is not I would require more return from Hyundai Motors if its total risk is higher, okay. HMC's total risk, who cares? Okay, what I care about is the total risk of my precious portfolio, okay, that is market portfolio, yeah. Yeah, so the risk premium is not a function of total risk of Hyundai Motors, but total risk of market, okay, or portfolio, or that of market risk, okay. Now, why diversification reduces or eliminates firm-specific risk? Firm-specific risk can be reduced, if not eliminated, by increasing the number of investments in your portfolio, being diversified, right? Market risk cannot. This can be justified on the either economic or statistical grounds. On economic grounds, diversifying and holding a large portfolio eliminates firm-specific risk for two reasons. A, each investment is a much smaller percentage of a portfolio, muting the effect, okay? Small piece, yeah. On the overall portfolio. B, firm-specific actions can be either positive or negative. In a large portfolio, it is argued these effects will average out to zero, okay, average. Here's the beauty of taking the average, right? For every firm where something bad happens, there will be some other firms where something good happens, right? Portfolio formation with Apple and ExxonMobil is shown in this picture here, okay? So what you see on the vertical axis is the expected return or average return of any portfolio. And then what you see on the horizontal axis is a standard deviation of the portfolio's returns, okay? So any dot will be a portfolio, okay? Any dot over here in this picture will be a portfolio, dot, okay? And then what you see over here, let me shrink down my picture. You don't need to see me. Okay, here you are. Good. This dot, okay? This dot over here is the portfolio 100% invested in ExxonMobil. Okay, XOM, ExxonMobil. Is historically, right, its average return in annual average return has been 15%. And then it's, okay, that's this guy. And then its total risk, right, was about 23% or something, okay? How about this portfolio that is 100% invested in Apple, your iPhone, over here, yes. Now, Apple stock expected return about 28%, okay, and then historically, and then their total risk about 48 percentage point, right? So in total risk sense, which stock is riskier? Apple, of course. And then the thing is, what you see on this nice rounded curve, okay, is each and every point over here, okay, is a possible portfolio, okay. For example, over here, okay, 50-50, okay, and then more onto ExxonMobil, and then more onto Apple. Okay, you can see that different weights of stocks in the portfolios, in each possible portfolios, and then we can draw a line that traces, okay, based on the different portfolio weights. Okay, portfolio weight always add up to 100%. You know that, right? Anyway. Then the red lines and then the green lines, what are the differences here? Well, red line is based on the reality, okay? Or based on the historical data, their correlation, the correlation of return of Apple stocks and return of ExxonMobil stocks turned out to be 21% or 0.21 positive, right? So it's positively correlated. And then if the portfolios, the component stocks, right? If the component stocks, their correlation is 100%, then it will line up in this straight line fashion like this, okay? On the other hand, if the portfolio's correlation, the component stocks return correlation is -1, it will be this sharp line pointed over here, okay? And then if the correlation between these two stocks is 0, it will be like this, right? Now what do you see? Well, if those two stocks are perfectly correlated, there's no reason forming a portfolio, okay? Because the portfolio is less than perfectly correlated, many times we see a benefit of forming a portfolio. Okay, what kind of benefit is that? Well, for a given level of for a given level of, let's see, the same risk. Okay, same level of risk. Well, you can expect to have better return, okay, for this case A versus case B, okay. Case A, okay, in the portfolio A, you have Apple and ExxonMobil combination, okay, whereas case B, you have 100% invested in ExxonMobil, okay? But A is more efficient than B because it gives us a better return for the same level of risk, right? So it's more efficient compared to B. And then if you look at these interval, like smooth interval, okay, you will see a very interesting pattern going on, okay? Compared to portfolio B, all the dots over here gives you better expected return, even though they suffer from lower level of risk, okay? Lower level of risk. Isn't it better? Okay, isn't it wonderful? Okay, isn't it much more efficient? And the answer is yes. So that's the beauty of holding this portfolio, okay? Why is this thing happening? As I said before, because the correlation is not perfect or correlation is very low, okay, very low. Very high correlation, of course, if the portfolio looks like this, right? Then, of course, you don't want to hold the portfolio, but usually low correlated stocks, right? By forming a portfolio, you will have you will achieve better efficiency than holding 100% on one stock. That's the key message. And then, next, move on. Right, 3 stocks in Korea, okay? I started with the discussion of LG Chem and Celltrion. Let's see their average daily return and the standard deviation of daily returns, but this time based on Hynix, the SK Hynix, the semiconductor company, okay? In terms of market cap, I believe this is number 2 in Korea right now, okay? Why is that the case? Because Samsung Electronics and then Hynix, the Korean industry is heavily focused on these semiconductors, especially the memory chips, right? They are the biggest global players. So that's that. Here, the basic information is that the Celltrions and then Hynix and LG Chems, their standard deviation of returns, daily returns, is, as you see, 3.16%, 2.08%, and 2.01% respectively, and their average daily return is shown, okay, 0.22%, 0.13%, and 0%. And these standard deviation of return will be shown in the horizontal axis, just like before, and then their mean return or expected return will be shown in the vertical axis. So let's see those 3 stocks. Okay, mean standard deviation. Okay, framework over here, plane. So three dots, we see it over here, over there, and over there. You see it? 3 different companies. Good. Now moved on down to the next slide. And what do we see? We see a beautiful scatter plot of possible portfolios based on these 3 stocks only. Okay. Here, based on the actual correlations among these pairs of stocks, right? Pairs of stocks. We have 3 pairs, right? SK Hynix and Celltrion pair, Celltrion and LG Chem pair, and then Hynix and LG Chem pair, right? So 3 pairs, 3 correlation numbers we got. Based on these actual correlations, I construct thousands of possible portfolios, okay? Giving different weights to these 3 different stocks, okay? And then plot them on the chart, okay? Then it will look like this, okay? Then it will look like this. Now, what do you see? Well, a couple of things in mind. Excuse me. A couple of things in mind. You see, as I told you before, for certain intervals, right? Certain intervals, you see better efficiency achieved over here. Better efficiency achieved. Okay, in this curve over there. Why is it efficient? For the same level of risk, it gives me better return than the line over here. Okay, this part is efficient. Okay, for the same level of risk, this part A gives me better expected return than B. Make sense? And then on and on. Okay, up to these levels, right? You achieve best expected return compared to other possible portfolios of the same level of risk. Compared to this portfolio, C, the portfolio on D is much more efficient. It gives me better expected return. Okay? So if I should form a portfolio based on these 3 stocks, those will be anyone based on these, anyone on this efficient line over here. Okay. As I also, okay, what I also find in this experiment is that as we increase the, stocks, what's that? Celltrion and then LG Chem. Okay. The case of holding only 2 stocks, okay, I could construct a portfolio, right, to a certain degree. Let's say, for example, if I form a portfolio based on LG Chem and Celltrion only, 2 stocks, right? A possible portfolio will form like something like this, right? Their returns will be like this. But as I include SK Hynix, this efficient area expands. Okay, so that's something we are worth noticing. And then as I increase the number of stocks, okay, different stocks going on, right? Four different stocks, 5 different stocks, or n different stocks. What happens? Well, it will form what's that? More and more efficient lines like that, portfolios, so that it will expand into more and more into like this, to a certain limiting cases, right? Limiting cases. And that hypothetical line, right? Hypothetical line is shown in the next picture.